Let's talk more. For what's coming up this week for the banking sector, let's bring in Jeff Harte, Managing Director at Piper Sandler. And Jeff, I just want to warn you that, raise your game here because Wilfred Frost is still here. Okay, so are you gonna be probing and asking questions for Jeff Harte here?
Am I answering questions or asking questions?
Well, you probably could answer them, but you can ask him some questions. He's the answer. But Jeff, let me start with the original proposition that Wilf put forward, and that is declining rates. But what about the offsets to that? The stock market, credit quality improvement, loans improving. Do all those things offset the what could be missing from a better yield curve or whatever that banks normally do? Is it still going to be pretty good?
I hope so, and I say hope, not expect. I mean, it's absolutely right. It's looking like a kind of a grind higher next year as far as what's going to drive earnings growth, assuming we get a lot of earnings growth, as opposed to some of the interest rate type catalysts we've had in past years. But I think the important thing to compare to is what are investors' expectations. And expectations have come down pretty far for the group. I mean, the yield curve actually is quite a bit more favorable now than it was a couple of months ago. So I think, as we look to next year, I think things look okay. As you mentioned, credit, GDP growth continues. There's some good things, but also the interest rate environment is certainly tougher. Loan growth is decelerating. So that kind of makes me look at next year in favor of the universal bank groups or the big guys for two reasons. One, they've got a lot of investment banking and trading as opposed to net interest income exposure, and I think there's a better revenue outlook there. But two, they've got scale, and scale matters more now than ever in banking. So I think their cost advantages will really shine through in 2020.
So how was trading in fixed income or wherever you want to look? And will it be monolithic across the group, or will there be winners and losers in how they manage through the last 3 months?
Well, so the last 3 months were okay. Now, the numbers are going to look pretty good versus the fourth quarter of 2018 just because it was really bad, especially in fixed income trading. So, I mean, there'll be kind of some variance there. But all in all, I mean, I think it was a fairly consistent trading environment where, equities were okay. Fixed income was probably a little tougher, more specifically in like rates and some of the macros. So you would expect, companies that are more skewed towards some of the macros to maybe have a little bit of a tougher quarter. But I think, again, the key this quarter is going to be not so much what happened in the fourth quarter, because guidance has been pretty clear there. It's what's the outlook in the next year, and can revenues actually grow some? And I think trading is an area where we could see some revenue growth next year, and hopefully management teams will talk to that.
Jeff, in terms of perspective overall for the group for upside the year ahead, I was looking at Goldman Sachs' average upside for the top 7 banks they cover, and it's only 5% share price upside in the whole year ahead, which I think gives perspective of some of the how they're priced coming into earnings season. What's your sort of typical upside for your coverage universe, and what's the top pick?
So as I look at my coverage universe, in general, I think they'll be up next year. As I mentioned, I like the universal banks. They've got scale when it matters most. I actually like Goldman the most coming into next year. Part of the reason you don't see as much upside in some of the consensus numbers here is a lot of people haven't updated yet. And I think as we get the rest of earnings updates kind of coming out, and we get some potential catalysts like a 1MBD settlement and what I think will be a positive investor day. I mean, they were going to do it last year. They postponed it till this year. I think there's a reason they're choosing to go this year. I think they have some good stuff to say. I mean, I think Goldman Sachs is going to be a good one this year. I mean, I'm thinking you're talking 15, 20% upside, maybe kind of strong. So it's not necessarily going to be a blowout year like we saw from some of these guys last year, but still a good place to be. Though I will say, when you look at how strong like a Citigroup or even a Goldman Sachs was in 2019, you got to keep that in the frame of 2018 was a tough year, especially the fourth quarter. So a lot of that rebound we saw was just recouping kind of what they gave back at the end of last year.